One genre of movie or video games that almost never fails to disappoint me is one that's centered around the zombie apocalypse. It's always fun to see a new idea, a new take, flavor, or twist from some director and producer on what their idea of a zombie apocalypse should look like. So, a good example is what we're looking at right here. This is a scene from The Last of Us in which our main protagonist, Ellie, is attempting to defend herself from a couple of clickers. There is, of course, always the absolutely eerie and harrowing opening scene from 28 Days Later, in which Cillian Murphy's character wanders around a completely abandoned London to try and find survivors immediately after apocalypse. There is, of course, always the absolutely hilarious and cult classic Shaun of the Dead. And then one definitely cannot forget the absolutely terrifying scene from World War Z, in which a literal mountain of zombies tries to get over a dividing wall into Jerusalem to get after survivors. But the plot of these zombie movies is essentially the same. There is a singular or group of survivors who find themselves in an absolute mess after a pandemic outbreak of some kind turns a significant portion, if not the entire portion of the population, into flesh eating zombies. And usually, if the movie or game is centered around a group of survivors, one of them meets a pretty gruesome end. Whether they get torn apart by zombies, somehow accidentally end up getting infected, or maybe even betrayed by their own group. But after that, usually what ends up happening is that when things look their absolute worst for the group and when things are completely hopeless, fortunes end up turning for them. This may be something in the form of like a cure is found for the virus or disease that creates the zombies, or maybe a safe haven becomes available, or a daring escape is made. But eventually, a group of survivors makes it out. And in many ways, in today's stock market, especially from the perspective of SaaS companies or software as a service companies, this is kind of the situation that they find themselves in, especially with the so-called SaaSpocalypse going on. Software as a service companies lately have been taking a big hit, especially in their stock prices, definitely with the advent of AI. The whole idea of AI basically being able to circumvent the entire software as a service model is something that a lot of investors and a lot of people have begun wondering about. And one company in particular that we're going to talk about today is ServiceNow. ServiceNow is one in that group of survivors trying to make it out of the zombie apocalypse of AI models that they find themselves in. And a whole bunch of AI models seem to be popping up every day. So, in today's video, we're going to be looking at ServiceNow. We're going to be understanding it as a business to see how it performs, looking at its regulatory filings, and particularly looking at the company's stock to see if it's investing in, and ultimately to decide if ServiceNow is going to be a survivor of the SaaS apocalypse or someone that's going to be torn apart by the zombie horde of AI models. So, let's begin. So, ServiceNow is a business. Who are they and what is it exactly that they do? ServiceNow is a software as a service company that essentially sells subscriptions to each of its software platforms to its clients. The company has an absolute myriad of different products and services that it does offer, but each of them can be categorized into four different distinct categories. The first of which is the technology segment. ServiceNow's technology platform allows their clients to manage all of their IT assets, both physical and digital, into a single seamless platform that can also act as a security apparatus for their clients, allowing their clients to identify and respond to different cybersecurity threats. These assets that they can manage can be anything from physical server racks to things like cloud assets or digital assets that are held in a private way. The second segment that ServiceNow has is its bread and butter, the CRM. CRM is the main platform that ServiceNow sells to its customers, but effectively it acts as a way to connect the front, middle, and back offices of any business. The CRM platforms that ServiceNow offers connect things and give capabilities to companies for things like quote generation, responds to requests for proposals, as well as customer service functions. They can also do things like field service operations for technicians and different sorts of support functions that may be necessary for continuity of service for their clients. The CRM platforms that ServiceNow has are also customized to certain industries as well. So there are different sorts of CRM platforms for maybe finance, a different one for manufacturing. ServiceNow also has retail customers, public sector customers, healthcare, and more. The third segment is its core business. Effectively, what the core business software programs that ServiceNow offers do is bring some critical functions that are internal to a company into one single platform. So essentially what this does is it integrates things like HR functions, legal and contract management, as well as things like facilities management, real estate, and other necessary functions for a company. And then fourth and finally is the creator and other segment. This category of software platforms effectively allows ServiceNow's clients to customize their own workflows and design their own CRM in a way that works for them in a low or no code environment. So effectively, you can have people who are not software engineers design a workflow for a business that can work for them. They also have pre-built templates, but their core functions of the creator and other segment are things like App Engine as well as RaptorDB for high-performance data demand that their clients may need. So now that we have an idea of ServiceNow and what it actually sells as a company, we also need to get an idea of how it actually makes its money, as well as some other key factors and metrics that we need to pay attention to. With respect to the company's revenue model, ServiceNow is a subscription-based business that sells the number of licenses/seats/users to its clients. This is typically done in a multi-year contract with its clients. However, ServiceNow is having an increasing number of public sector clients that prefer a 12-month format for the company. The go-to-market strategy for ServiceNow is largely dependent upon its large in-house sales and marketing force that rely on tactics like referrals, digital advertising, trade shows, as well as attending industry events and being a part of brand campaigns in order to build its customer base. ServiceNow is also growing a lot recently as a result of some acquisitions it's done, as well as a planned acquisition for the end of 2026. The planned acquisition that's supposed to close before the end of 2026 is for a company called Armis, which is a cyber exposure management company that is supposed to bolster ServiceNow's offerings when it comes to its technology segment and the security apparatus capabilities it has. This is supposed to grow the total accessible market it has in that sector as well. That deal is supposed to close for $7.75 billion in cash and debt. Another company that ServiceNow acquired is one called Moveworks for $2.4 billion in cash and stock. That was done on December 15th, 2025. Moveworks is an enterprise search and a front-end AI technology firm. What ServiceNow acquired Moveworks for was not only to improve the CRM capabilities of the company, but also to integrate AI agents into ServiceNow's offerings so that ServiceNow's clients can use AI agents in their own businesses. The third recent acquisition was for a company called Veza Technologies, which is an AI and identity security firm that is supposed to also bolster the security capabilities of ServiceNow. That company was bought on March 2nd, 2026 for $1.2 billion in cash. And then finally, a company called Logic.io was bought in May 2025 for $506 million of cash and stock, which is an AI-powered CPQ engine, which is configure, price, quote, meant to bolster the CRM capabilities of ServiceNow so that way its clients can get better information and better information to their potential clients faster. As far as key metrics, the one that ServiceNow pays attention to is something called renewal rate. This is essentially 100% less the attrition rate that the company defines, which is known as lost actual contract value from existing clients divided by the sum of all total contract value the company has on its books. This 97% number effectively represents very high switching costs for ServiceNow's customers. So this is actually a really important number because the higher it is, the better it is. And because it's so high, this means that ServiceNow has a very sticky ecosystem, which is a good thing for the business. As far as customer base, ServiceNow operates in more than 50 countries and has roughly 8,700 customers worldwide. Of those 8,700 customers, about 630 of them have at least $5 million of existing actual contract value remaining on their deals. Another key metric to pay attention to is something called remaining performance obligation. This is effectively unearned future revenue that ServiceNow can capture on existing contracts it has. And as of March 31st, 2026, this sits at about $27.7 billion. However, the RPO metric does move with other factors, so this can change. It's subject to things like exchange rates, subscription start dates, the product mix and offering that exist on those contracts it has with its clients, the timing of renewals, as well as the total deal duration. So now that we have an idea of what ServiceNow is as a company, how it is they make their money, and what it is exactly that they sell, we can then look at the company's latest financial results and its regulatory filings as of the first quarter of 2026 and compare that to the first quarter of 2025. Now, with respect to ServiceNow's income statement as of the first quarter of 2026, we can see that the company did about $3.7 billion in business, 3.6 of which came from the subscription revenue the company earns, and about $99 million came from professional services. This is up 22% year over year on a quarterly basis compared to 2025, which is a great result. This is primarily because of the fact that the company is finding more customers, but also slowly growing the amount of offerings it has to existing customers. Regarding expenses, the first thing that we can see is the cost of revenue related to subscriptions and professional services. In 2026, in the first quarter, that came to about $940 million. This means that the company's gross profit was about $2.8 billion, or roughly a 75% margin. Now, while these expenses have gone up compared to the first quarter of 2025, the company's gross margin actually got a little bit worse. It was about a 79% gross margin in the first quarter of 2025 compared to only about 75% in the first quarter of 2026. Moving into the operating expenses that the company has, sales and marketing, research and development, and general and administrative all went up. And the unfortunate thing about these expense changes is that they also went up incommensurately with revenue. So because of this, we saw a 25% increase in G&A, we saw a 17% increase in research and development, and a 15% increase in sales and marketing. This means that the company's operating margin is about 13.3% compared to about 14.6% from a year ago. All of this is due to increased personnel costs. ServiceNow just has to hire more people in each of these departments to service more clients. So while the business is growing, unfortunately, margins appear to be shrinking. There are also some other expenses that we'll talk about in a second, like stock-based compensation expense, as well as depreciation and amortization that ServiceNow takes into account. But overall, net income for the first quarter of 2026 was $469 million. This is a $9 million improvement compared to the first quarter of 2025. Next, we're going to be taking a look at ServiceNow's balance sheet, comparing the first quarter of 2026 to the first quarter of 2025 to get an idea of the overall financial health of the company. And the first thing that we can note is that total assets have actually come down by roughly $1.7 billion compared to the first quarter of 2025. This is mainly due to the fact that ServiceNow has about $1 billion less of cash and equivalents, and there was also a downturn in the marketable securities that the company has on its balance sheet as well. This is mainly probably because of the fact that ServiceNow did several acquisitions between the first quarter of 2025 and the first quarter of 2026. So it does make sense. And this overall negative change was partially offset by increases in long-term asset value. So for example, we can see that goodwill, as a result of the acquisitions the company made, went up by roughly $1 billion. And we also saw an increase, though modest as it is, in something like intangible assets. There was also a reduction in accounts receivable, which is favorable for the company from a cash flow perspective. But overall, it looks like what ServiceNow is doing is basically taking its cash and marketable securities and turning that into new business acquisitions that the company has. We can also see that reflected in something called strategic investments on their balance sheet, which is reflective, or what they define as investments into different companies and acquisitions that they have done. With respect to liabilities, the company's liabilities decreased by roughly $400 million year over year on a quarterly basis, and this was almost certainly because of accrued expenses coming down, as well as a current portion of deferred revenue coming down. It looks like ServiceNow also decided to use some of its cash to pay off existing bills that the company has, as well as collect on some deferred revenue that it also has. So while this reduction in liabilities is a good thing, it's not nearly to the same degree as the reduction in assets that we have seen on the company's balance sheet as well. Regarding liabilities, this isn't something that I would think is a red flag at all. The company's just basically making use of some of its cash and then paying some of its bills, as well as collecting on some of the money that it's owed. With respect to the shareholders' equity side of the balance sheet, the first thing that we can note is that this is also a significant reduction in stockholders' equity on a year-over-year basis as well. We're at about $12.9 billion of total stockholders' equity as of the first quarter of 2025. That's now down to about $11.7 billion of stockholders' equity as of the first quarter of 2026. This was primarily defined by the increase in the amount of treasury stock that the company has on its balance sheet. That went up by roughly $1.3 billion. And this is probably because of some buybacks that management is doing of the company's shares. In addition to that, we saw an increase that offset this treasury stock increase in the APIC account, or additional paid-in capital. This is probably because of existing acquisitions that the company may have done. There could have been some other entries on its books that may have changed this. And we also saw an increase of about $500 million in retained earnings to offset that treasury stock increase as well. Overall, a net decrease, but there were some factors that offset it. Next, we're going to be taking a look at ServiceNow's cash flow statement, starting with the operating cash flows. And as of the first quarter 2026, from what we can see, the company did $469 million in net income. And then operating cash flow is added back from non-cash expenses like $258 million of depreciation and amortization, amortizing deferred commissions, as well as something pretty significant, $547 million in stock-based compensation expense. So it looks like ServiceNow is also issuing a bunch of stock, or awarding a bunch of stock, to potential new shareholders as a result of these acquisitions in order to make them happy. That is also bolstering operating cash flow for the company. Now, regarding working capital turnover and changes in working capital, the main things that we can see is that there was a pretty big change in accounts receivable as a net inflow of cash, as well as changes in deferred commissions, AP, deferred revenue, as well as accrued expenses. Overall, these changes amount to something slightly favorable for ServiceNow, roughly in the neighborhood of $200 million in net working capital changes on a net basis. And from what we can glean from this, there was about $1.67 billion of cash from operating activities for ServiceNow. Moving into the investing and financing activities for ServiceNow, there are definitely some things to take note of. The first of which, with respect to investing activities, has to be the business combinations net of cash acquired. That was a $1.3 billion outflow as a result of all of the cash that they had to award to their targets that they acquired. Now, this is mainly something that isn't a huge concern, especially from a free cash flow perspective, because we're mainly concerned about purchases of property, plant, and equipment, of which was only about $141 million. This means that ServiceNow's free cash flow is sitting at somewhere around $1.5 billion, which is pretty decent for the first quarter of the year. In addition to that, we also saw inflows of the sale and maturities of marketable securities. So it looks like ServiceNow took some treasury bonds, or maybe some commercial paper, or some money market funds that were sitting in accounts, and used that to help with the acquisitions of the companies that it recently bought. Overall, net cash from investing activities was an outflow of roughly $451 million. Moving on to financing activities, there were also some other big changes. There was a $2.2 billion repurchase of common stock, which makes sense because we saw a significant increase in the amount of treasury stock on the company's balance sheet. This financing activity change resulted in a net outflow of about $2.2 billion. Regarding other things that happened on financing activities, these were probably consistent items like proceeds from employee stock plans, as well as taxes related to the settlement of equity awards that probably haven't changed much, or they really haven't changed much on a year-over-year basis. So the main thing was the repurchases of common stock. So now that we have an understanding of ServiceNow as a company, have an idea of how the company makes its money, as well as what its recent financial performance has been, we can now do a SWOT analysis on the company to assess its strengths, weaknesses, opportunities, and threats. With respect to strengths, the first one has to be its earnings quality. With 8,700 customers around the world and a $27.7 billion RPO backlog and a $12.6 billion current RPO backlog through 2027, ServiceNow is not in a position where it's overexposed to a single customer or single accounts receivable. This really boosts earnings and revenue quality for ServiceNow, because if some of its clients do decide to switch, the company's earnings suddenly aren't going to go off a cliff as a result of lost revenue due to overexposure to a single customer. Also, I didn't find much of a history of bad debt expense, which is also something that bolsters the company's earnings quality. Another strength has to be its platform and its platform synergy and client switching costs. Because of the CRM, the internal business functions, the technology and IT security, as well as things like app development and RaptorDB, the switching costs to move to a different company for ServiceNow's clients is extremely high. When you have so many things handled by a single company that handle workflows, customer orders, customer service, intercompany communications, any type of function or task that needs to be handled, it makes it very easy for a client to get comfortable with their systems hence why ServiceNow has a 97% retention rate. And because of that retention rate, that means it's probably really expensive for ServiceNow's clients to switch to a competitor like Salesforce. With respect to weaknesses, one of them has to be the seat-based pricing model that ServiceNow relies on. This is essentially a bit of an outdated system because of the fact that when a company like ServiceNow issues licenses to individual users, this is something that can be changed very easily by its clients, and this is especially true as a result in the advent of AI. One thing that ServiceNow is slowly transitioning to is a usage-based model for its clients, and that's because of the fact that clients may have to adjust what their needs are from ServiceNow's software platforms as a result of their own AI moves or AI implementations into their own businesses. Another weakness is ServiceNow's valuation. The current valuation of the company is currently pricing in perfection, at least when it comes to earnings guidance, when it comes to execution on synergies of acquisitions, existing deals with customers it has, as well as growth assumptions and projections by investors. This leaves little margin for error for the company, and if there is a bad earnings call, missed or bad guidance, maybe a missed earnings target or something of this factor, that can call into question the company's stock price, and it may come down as a result. As far as opportunities are concerned, it has to be the expanding total accessible market, especially on the security front. The recent Armis acquisition is a very big opportunity for ServiceNow because not only does it bolster the company's security capabilities, it also expands the market, the cybersecurity market that ServiceNow is starting to enter into. This can definitely have revenue growth and contribute to profitability growth for the company. Another opportunity for ServiceNow is AI. ServiceNow has had made strategic moves, namely with acquisitions, particularly with MoveWorks to implement AI into its own business. Now, the front-end AI agents that it's going to use for its CRM software has yet to be declared a failure or a success, but if done correctly and if ServiceNow pivots correctly into AI, it could be a really, really great opportunity for the company that they can capitalize on. With respect to threats, AI is also a threat while also being an opportunity. While AI can bolster the company's capabilities and offerings to its clients, it's really a double-edged sword and can threaten this business because its customers could theoretically just as easily implement the same AI functions into their business that ServiceNow already provides. So if you're a client of ServiceNow and you know that you have AI and you know that AI is doing a good job for you, it may reduce your need for reliance on ServiceNow's products and services. The other one is CRPO deceleration. The current remaining performance obligation of the company has come down quite a bit, about 150 basis points since last year. And for the stock price, this could be bad news, especially if that continues to decelerate. Now, a lot of the RPO metric is subject to changing things or changing terms like timing of contracts and duration of contracts and these sort of things. So it could come back up. But if CRPO continues to decelerate, then short to medium term revenue for the company may not look so great. Next, we need to gather some key stock quote data and financial metrics on ServiceNow in order to do our discounted cash flow analysis. And as of the date of this recording, the company's stock price was trading as of market open on July 8th, 2026 at about $107 per share. Over the last 65 days, there's been about 29.1 million shares exchanged between buyers and sellers, and the company has a market value, or also known as market cap, of about $114.2 billion. There's just over 1 billion shares outstanding available for trading. The company earns $1.68 per share, and it has a price to earnings ratio of about 63.4. ServiceNow currently does not issue a dividend, hence no ex-dividend date and no dividend yield, but we can also gather that the company has a beta of 1.47. What this tells us is that ServiceNow's stock price is actually slightly more volatile relative to the rest of the market. In addition to that, the current number of shares shorted at ServiceNow is about 59.5 million shares. This is roughly 5.8% of public float. The first step in our discounted cash flow analysis is to take some of the data that we've collected so far from the financial metrics, as well as make some base assumptions and input all of that into our model. The first assumption that we're going to make is a 2% terminal growth rate for the company. And then right here is where we put the current stock price, the shares outstanding, the beta, and the dividends per share. We're also going to need the current yield on the 10-year U.S. Treasury bond to get an idea of what our risk-free rate of return is. We're also going to assume that an equity investor will expect about a 9.5% rate of return on their investment in ServiceNow. And the company's debt has about a 1.5% weighted average interest rate on it. Next, we can then calculate what the company's weighted average cost of capital is. And as of its latest filing, the company has about $1.49 billion worth of debt, about $11.7 billion worth of shareholders' equity, and $2.7 billion worth of cash and equivalents. This means that ServiceNow is weighted about 88.7% towards equity, about 11.3% towards debt, which means that the company's weighted average cost of capital is about 10.65%. The next step in our discounted cash flow analysis is to take a look at the company's historical free cash flow, forecast the company's future free cash flow, and then come up with the valuation and the implied share price of the company. Now, the first thing that we need to do is take the company's historical free cash flow, which is this data in blue in the second column right here, input it into our model, as well as forecast what the company's future free cash flow is going to be, which is the data in black below it right here. Now, based upon what ServiceNow's earnings growth, revenue growth, and expense growth looks like, I do expect the company to continue to expand its free cash flow, especially considering that the company still awards a lot of stock to acquisition targets or employees, so a lot of stock-based compensation expense, as well as pretty aggressively amortize some of its goodwill and IP on a 3 to 5 year basis. So this will bolster free cash flow, but I think the company is going to hit a point of diminishing returns, especially when it comes to its net income, which is why things will continue to grow, but growth will slow down, I think, coming into 2028, 2029, and 2030. So I'm predicting about $7.9 billion of free cash flow by the end of 2030, and that's worth about $4.3 billion of free cash flow in 2026 dollars. Now, the reason why that is because we have to discount the company's future free cash flow back to today's present value, and we do that at the company's weighted average cost of capital, or 10.65%. Next, we then move into the certain valuation methods for ServiceNow, and the first of which is the terminal valuation. The terminal valuation of a company is effectively the maximum potential value we think the company can reach based upon investment assumptions we've made and also beyond the period at which we're forecasting the company's future free cash flows. So this is effectively the maximum potential value of ServiceNow into 2031 and beyond. It's about $51.3 billion. The enterprise value using the free cash flow method of valuation takes that terminal valuation and adds all of that free cash flow over time to the company's value. That comes out to about $90.1 billion. And then the other method is the enterprise value valuation method using equity, which is the sum of the company's debt and equity financing less the cash it has on its books. So in the case of ServiceNow, we're going to use the free cash flow method. And if we divide that by the company's share price, that means its implied share price using this discounted future free cash flow method and our forecasting method of what we think the company's free cash flow will look like in the future is about $87.56 per share, despite the fact that ServiceNow is trading at about $107 per share. Now, let's say that you decided to buy 1,000 shares of the company on July 8th, 2026, and you were going to sell all those shares at the end of 2030. If ServiceNow's valuation was purely based upon the company's discounted future free cash flow and you would not receive any dividends in the future as an investor, then your IRR on your investment is about negative 4.38%, which is not great. Finally, we're going to be doing some technical analysis on ServiceNow's stock to see if it's a good time to enter into a position in ServiceNow and get an idea of where we think the stock price is going to go in the short and medium term future. Now, right here in this chart, we have a 100-day moving average with Bollinger Bands around the company's tickers, as well as the RSI down on bottom. Now, as of today, ServiceNow is actually trading above its 100-day moving average, and it very recently indicated that it was overbought slightly by the RSI. So what this indicates to us is that we could see some bearish price action on ServiceNow, and it also recently broke out of its bearish Bollinger Band line. So what this tells me is we'll probably continue to see some price correction with ServiceNow, but nothing to the point that would probably push the stock below $100 per share. What's interesting as well is that the bullish Bollinger Band line is sitting at about $87.86 per share. That's right where our price target is for the company, and that's likely where we've seen support for the stock price in the past as well, especially considering that this chart indicates what ServiceNow stock price has done since the beginning of 2026. Now, my guess is that we probably won't see the stock price come below $100 in the immediate near future, but it very well could, because that's where it looks like support has been in the past. So ServiceNow is a company. Will it survive the SaaSpocalypse? Will it survive the zombie onslaught of AI models encroaching upon its business model and ultimately spell its doom? Almost certainly not. ServiceNow is a big enough player in this game and is a smart enough player in this game to be able to adapt into the era of AI. Now, granted, the company's valuation has taken a hit recently as a result of developments in AI, and the company definitely has some big questions that it needs answered and some key strategies it needs to execute on in order to be a successful SaaS company of the future. So, what about this company's stock? Is it a buy, is it a sell, or is it a hold? Well, actually, in my opinion, I actually believe that ServiceNow is a hold. If you hold stock in ServiceNow, I would hang on to it. It might be a little bit too expensive, however, at the moment to be a good entry point for ServiceNow because my target price for the company as of today is about $88 per share. I think that our discounted cash flow model got it pretty close. And I also think that the company does have some growth problems that it will encounter in the near future, especially considering it has a very heavy reliance on a large workforce to support its clients. But I'm also curious to know what you guys think. Let me know what you think of the stock. Let me know what you think of the data, the model, the analysis, everything in the video. I'd love to hear your thoughts. And if you guys have a request for a new publicly traded company, make sure you let me know down in the comments of which company you want to check out and we can do the analysis together. As always, thanks for watching.